The whole point is start policies as early in your life as possible and get as much money in those policies as early as possible. The longer you give it to grow, bigger it gets, the more you can use. Everyone has some sort of money flowing somewhere, and most people have it flowing to the wrong place. A bank then takes that and lends it out to other people to make a spread on the money. So instead of it flowing to a bank, have it flow to a policy. Now you can take it and make a spread on money. That's all infinite banking is.
It's all about taking that lazy cash, as we call it, and putting it to work.
Bring on Devin today, Mr. Burr and Craig Yenny, our money mentors, to kind of go over infinite banking and how they're using it in their lives. So
you've got a dinosaur behind your head. It pops up every once in a while.
It's the Pee Wee Herman. I don't know if you've ever seen Pee Wee's Big Adventure, when he's in the desert.
Too funny.
Yeah. That's
cool. So everyone that's new, thanks for joining us. And everyone that's not new, thanks for coming back. One thing I want to touch on real quick, guys, is what we teach with infinite banking, becoming the bank. It's amazing, but it's only as good as you make it. It says in the title, infinite banking. There's infinite possibilities. You can do so many things with it. So based on how well you use your policy is going to determine how well you do with infinite banking. So that's why I think it makes a lot of sense for you guys to always have these trainings, always just kind of see how we do things, because I personally have 12 policies or 13, I think, and I use them for everything. So I'm going to go over one of the ways that I use mine, and you guys can ask questions. I'm an open book, and then I'm sure Craig will do the same thing. So first things first, with a policy, it's all based off of compound interest. Okay. You put money in a policy, it's guaranteed to grow and compound for the rest of your life. The longer you give it, the bigger it becomes. That's compound interest, right? Best time to plant a tree is 20 years ago. The next best time is today. So if you can compound your money, it's amazing, right? You just have to give it time. What if, though, you could compound that money in two places at the same time? So I'm going to show you guys how I actually do that. So what I do is I flow all of my money through policies. That's why I have so many of them. And once it goes there, I look for opportunities. So I think I can borrow from the policy at 5%. If it costs me 5% to control the money, what opportunity do I have where I can go make more than 5%? That's infinite banking in a nutshell. Borrow at 5, control the money, go make more with it. So what I do is I do a lot of private lending. You guys probably know about Private Money Club, obviously, huge thing that we do. So what I do, I take the money, goes into a policy, it's guaranteed to compound and grow there. Borrow against it at 5%. And then I lend it to a big investor. I lend to is Nicole and Rob Fuller. So in the chat, maybe a hands up or a wave. Anyone else lending to the Fullers? Drew. Okay. Anybody else? Yeah. All right. So guys, everyone that invests with the Fullers, it looks like quite a few. It's probably the least risky investment in my opinion, because they give you a first lien position and a personal guarantee. So there's no real risk. And then they actually buy all the land that they're developing properties on with their money. So they have skin in the game. So there's built-in equity in each of their deals. So not a ton of risk. What I do is I borrow from my policy, lend money to them. And then when they pay me interest, I lend it back to them. So I'm getting compound interest with them and compound interest in my policy. If you guys want to write this down, I don't know if you have a pen or paper, but I'm going to give you actual figures. So as of today, I have $1.2 million lent to the Fullers. That comes out to $15,000 a month. So what I do is I let that build up for 3 months. After 3 months, I'd have $45,000 they've paid me. I take it, I lend it back to them. So now I've got 1,245,000, and that's at 15%. So it's going to make me now 15,562 for 3 months. I just simply lend it back to them. So now I'll have $1,291,687, making me 15% interest. So now it's making me 16,146 a month. Again, I just let it build up for 3 months and then lend it back to them. So 1 year from now, by just doing that, I will have almost 1.4 million lent to them at 15%. That's $17,379 a month in passive income. I don't have to do a thing for that money. It just shows up, deposit in my bank account every single month. Mind you, the entire time, the 1.2 million is still in the policy, compounding and growing tax-free. I just borrowed against it. So I have 5% I have to pay to the insurance company for borrowing their money. All I do, I write a check from my business bank account. So all of that interest is a tax deduction. So that's just a simple way, guys, that you can use a policy to literally get compound interest in 2 places. From a very, very low risk investment where you have a personal guarantee, first lien position, and skin in the game. The operators have skin in the game. I've been loving it. So if you guys have any questions, down to answer anything you can think of.
My question is have you noticed, like, from where you might have come from, like handling money like in the old mindset, in the old way, like once you get this, like how much of a fast track does it take to really start making the right moves and all that sort of stuff? Because I feel like for some people who might just be getting into infinite banking, it's a big mindset shift. And then I feel like once you get through that, like once you like kick down those old doors, like you really kind of move quickly once you get through that.
For me, I'm really good at math. It's just one thing I've always been good at is math. In school, I got horrible grades, but in math, I had like A's and B's. So I've always just kind of understood numbers. And at its core, infinite banking is just making a spread on money. That's all it is. Like I said, you're borrowing against an asset that is always growing. The policy is guaranteed to go up. So if that's the case, and it is, because it's contractually guaranteed, if it's always going to go up, that means you always can borrow more. And if you're borrowing at 5%, that's what it is right now, as long as you can just take it and make more than 5%, that's all infinite banking is. If you can go make 30, 40%, it's better than making 10 or 15, right? So it's all about the opportunity. And I saw that early on. I was like, all right, this makes sense. I've got an asset that goes up. It'll appreciate guaranteed. I can borrow against it. So it just keeps going up. If I can borrow and control money at 5%, I just got to go make more than 5. That's infinite banking. Super simple. Once I figure that out, that like, that's all it is. So many people want to overcomplicate infinite banking because I think it says it in the title, infinite banking. There's so many ways to do it. So you can overcomplicate it. But if you just put it down to its core, you're borrowing against an ever increasing asset, controlling money at a certain percentage, 5%, let's say, just go make more than 5%. That easy.
So Devin, this is really cool. And there are some questions coming through the chat. And one in particular is, how do we teach others to do this? So there's private lending, and there are some coaching, but for people that want to learn how to do what Devin's talking about, there's different pieces to it, right? There's getting started with the infinite banking process itself, but then how do you become a private lender? How does that work? What's the safe way to do that? So Devin talked about personal guarantees, first lien position. So there's different aspects of what you want to make sure you do in a private lending situation. Shauna just posted the link to the Private Money Club Accelerator program that Noah teaches. And that, if you've never done private lending, that's a great thing to take a look at. And that'll teach you kind of the basics of how to protect yourself. Because the last thing we want to do is lose money, right?
Yeah, and actually Accelerator just started this week. The first session was on Monday, the next session is tonight. So it is also not too late to hop into that cohort, because you can easily get the video from Monday and be on tonight's coaching call.
And Devin, so in terms of the Fullers, I know they have the fund, but do you do some private lending where you're in first lien positions on different properties? Do you work with other real estate investors in that manner too?
I do, just not a lot, because I don't want to take the time to vet the people. Like, that's the biggest thing with private lending. It's very, very passive once you've vetted the operator, once you've done all that. So that takes time. You have to really make sure you're lending to someone who is credible, someone that has a track record. You have to have safety nets in place to make sure you're not going to get burned. So the lien positions, all that kind of stuff. So that takes time. And I just don't want to spend time vetting more investors. So I lend a lot to the Fullers, and then I have 2 others that I lend to. And right now I'm just not looking to lend to anyone else. I'm trying to stay liquid at the same time, because I feel like things are going to change here soon with the real estate market. I feel like there's going to be a lot of foreclosures coming. So when that happens, I want to be liquid so I can pounce on those deals.
Yeah, to that question, it looks like Jimmy Davidson in the chat said, are you seeing real estate prices becoming more attractive in Arizona and maybe changing your mind to jump back into the real estate game? So it did sound like you are considering that.
Yes, but probably not single family homes. I'll probably be jumping back in to multifamily. And yeah, I don't know when it's going to happen. I wish I had a crystal ball, but I think probably within the next 12 months, the market's gonna turn a bit. I think it's gonna be because of foreclosures.
Yeah, which is unfortunate.
Yeah. And there's gonna be a second wave probably, because I think AI is gonna take a lot of jobs, and then people aren't gonna be able to afford their mortgage. So more foreclosures once that happens. Who knows when that'll be? Not to be doom and gloom, but
yeah. Hey, Devin. So James got a question in the Q&A. He's asking if you can kind of walk through the first time you used infinite banking process. So what you're describing is you're kind of in the maturity of having multiple policies, probably lots of cash value built up. But what would this look like for somebody that may be just starting? What can they do?
So Jimmy, my dude, hope he is great. I used my policy for the first time in May of 2020. So I had a small policy. Anyone that's kind of followed Chris and me for a while, you know the story. I was gung-ho about the whole concept. I had like 300 grand I was going to start a policy with, all of my capital. And then I got spooked. I heard people saying life insurance doesn't work like that. You're going to put all the money there. You're not going to be able to touch it for 5-10 years. And I got just freaked out. So I hit Chris up and I'm like, dude, I still want to do this, but I want to scale it back a little bit. And he's like, okay, how much? I'm like, let's do, instead of 300 grand, let's do 6 grand. So Chris hated me, but I started a policy for $6,000. I had access to like 5,000 within the first week. So what I did is I borrowed the 5,000 out of the policy. I had a friend that bought her first real estate deal, just a rental, and she didn't have the money for the closing costs. It was like $4,800 or something like that. So she was going to get a personal loan for 20-something% interest. I was like, how about I just lend it to you at 18? And she was like, would you do that? I'm like, yeah, I just need a lien position. So we did a promissory note. I had a lien position for $4,800, and she was paying me 18% interest, which was, I can't even remember. It was like $300 or something. So I just took that, put it back in the policy. It built back up. And then, yeah, after I saw it worked, I got 2 more policies, one for 125, one for 150, one on me, one on my wife. And by the end of that year, I had 4. That was 2020. So again, guys, it's just about making a spread on money. I knew if I could make more than 5%, which was what I was borrowing the money at, it made sense. I was going to make 18 and borrow at 5. So that means I turn 5 into 18. That's what's that, like a 300% return? And that doesn't count what's happening in the policy. I'm making in the policy 5 to 6% tax free.
Yeah, that goes right back to your point. It's just math, and it was on a small scale, and you just scaled it from 6,000 all the way to 1.5 or more. 1.5 just with the fullers there.
It happens quick, guys. Like, it happens quick. Like, I kind of have to pinch myself sometimes thinking that it was only 3.5 years ago, I was learning about this. And I'm like, this is the craziest thing. How come I have not known about this? I'm 34 years old at that time. I'm like, man, if I would have known about this when I was like 24, I'd be on like a yacht with a helicopter pad on the yacht. Who knows? But
well, Hannah is 24 and she bought a penthouse at 24. So
so there you go.
That's about right.
When she's my age, she'll have multiple jets and all kinds of crazy stuff.
Brian is asking, I'll ask you and Craig this. Do you use any of your policies as simple emergency funds?
Yes and no, because I look at it as, if the money's just sitting there, it's better sitting there than sitting in the bank. Let's put it that way, because it's protected against lawsuits and judgments in most states. In your bank, it's not. So if someone sued you, they could take your money out of a bank account on a judgment or a lawsuit. So it's better sitting in a policy than it is sitting in the bank. It grows more than it does in the bank. It gives a death benefit. The bank doesn't. So to have it sit there, it's better than sitting in the bank. However, it's not maximizing the policy if you just let it sit there. So what I try to do is I try to get the money out and moving, bringing me back cash flow. So I use the cash flow as my emergency funds. Right now, I think we have, with everything, around 40,000 a month in cash flow. So our expenses, if we live our same kind of lifestyle, are about 15,000 a month. So 40,000 a month is coming back in as cash flow. That's our emergency funds. We probably will never need to use all of the 40 grand. So I don't really let money sit there. I have one policy that's sitting, but it's a small amount. It's for my daughter. I think there's like 10 grand in it.
Chris brought up a point about also for anybody who has children who might be reaching college years, is that, like how there's like FAFSA, like student aid, I guess, like money in a policy, they don't even consider that. Like, so like if you have money in your policies, like, and you needed, like, I think if you have savings accounts or you have checking accounts, like it's somehow that gets factored into what your child could be eligible as far as student aid and stuff. But I guess the policies, they don't even look at that stuff, which is very interesting. I heard that a week or two ago.
Yeah. That's correct, because it's a private contract. It's a contract between you and the insurance company. So it doesn't need to be reported to anybody.
I just found that interesting. Anybody's
I wanted to add one thing I want to add to Brian's question is, as far as how much cash you have laying around, that almost comes down to each person's comfort level. So there are some people that are completely okay with putting all their available dollars to work, and then, like Devin talked about, generating that income that'll pay for the bills. But there are some people that may not be able to sleep at night if they don't have some money that's liquid, that's available. So just like Devin was talking about, the best place to store that would be in the policy. Now, guess what? If you had, let's say you had $100,000 out working from your policy, well, guess what you have is $100,000 loan in the policy. If you have money, you could put it back towards the loan, to pay down that loan, and that money is available right away. So that could be an emergency fund. There's so many cool ways to wire this up. And so it kind of just depends on what you're trying to accomplish, but you can store the money in the policy, you can repay the loans, that's accessible right away again. So there's a lot of different ways to wire this up. Nicholas is asking how often you pay back your insurance loans.
See, that is something that you'll get mixed answers on that from people. It's like, for me, if the money is making me money, I'm not worried about paying the loan back. I'm just worried about the money continuing to work. So if I don't have a place to put the money, then yeah, I'm going to pay the loan back, because then it doesn't make sense to have a loan out where it's accruing interest and having money just sit in the bank. But if it's out working, bringing me more, I don't care about paying the loan back. If you're using the policy to, let's say, buy a car or buy a boat or buy whatever, in those situations, I think it always makes sense to pay the loan back. So for instance, if you borrow $50,000 out of a policy to go buy a new car, if you bought that car from a dealer, you'd have to pay the bank or the lender interest and payments each and every month without fail, or they ding your credit or they take the car, right? So in that situation, the car is not making you money. So in that situation, I'm always going to pay policy loans back at the same amount or higher than what the finance company would have charged for that car. Hopefully that makes sense.
Yep. And a lot of times we'll look at it as, depending on what you're trying to accomplish, you may not want that policy loan interest compounding on you. So at a bare minimum, if you just pay that, you're going to be in good shape.
Well, yeah, let me rephrase that. I always do that. Whatever the interest is at the end of the year, I always pay at least the interest. And I kind of touched on it before. What I do is I write that check from my business bank account and I use that as a tax write-off, as a business expense, because I'm using the money for business. I'm using it to lend on deals. I'm using it to make more money. So it is a business expense. So as long as you pay that interest, it's not being tacked on top of your balance. So you're not getting compound interest on what you're paying. To
that point too of a business expense, Mary is asking in the Q&A, and then Russ is asking in the chat a similar thing is, is the entire BYOB process tax-free? Like what procedures might result in taxation? So for the most part, I'll let you guys handle it, but when you're making money, you're paying taxes.
For the most part, yeah. Like in the policy, guys, there's no taxation as long as it stays out of being a modified endowment contract, which that's what our team does. We make sure you hug up against that line where if you go over, it becomes taxable. As long as you stay under that line, it's never taxed. So in the policy, no taxation. Outside of the policy, there's taxation if you go make money. There's ways to get around that, I guess, with like profit and loss and different things that your accountant can do and all that kind of stuff. Foundation and trust structures that some of us have set up. I've got my whitening trays in, so I might be lisping a little bit. Sorry, guys. So yeah, there's ways around it. Like one of the ways that I do is my daughter, she does little administrative work for me at my business. So I pay her. It's like $12,900 a year that I can pay her from my business. Business can take it as a tax deduction, and then she does not have to pay taxes on that income. So that's tax-free money. I take it, put it into policies in her name. So now that money's growing tax-free. I can use it tax-free. I didn't pay taxes on it going in. And then when she passes away, way down the road, her kids, they'll get a death benefit tax-free. And then it's all within our trust structure. So basically the trust dictates that that money, when it comes in from the death benefit, has to purchase more policies, which grow tax-free. So there's ways to really, really build a ton of wealth over time through policies by avoiding some taxation.
I almost want to call infinite banking and our team specifically, we're like the gateway drug to like making more money. And then you're going to learn how to deal with taxes and stuff like that. It's all kind of like, once, I don't want you to ever be afraid of infinite banking or afraid of taking on investments and afraid of growing your wealth because you're afraid of the tax man. Like as you start learning about infinite banking, it will spiral into like Devin learned about infinite banking, and then later on it spiraled into learning about trust structures. Like it does spiral and it grows progressively with you, the same way like when you have a baby, they don't come out a toddler, or like you kind of like work your way into this process, and it's one thing after another, and it's always growing and evolving. So don't be 100%. Shy about making wealth, guys.
This is such a good question. I want to answer this one. It's do you recommend to get a policy for a 3-year-old? How much of a premium is appropriate? Want to use it for future educational purposes? What kind of medical exam is performed on a toddler? Great, great question. So yes, 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 and yes. You should get a policy on that toddler yesterday. Because as I touched on at the very beginning, compound interest takes two things: time and consistency. So if you're consistently putting money into a policy for a 3-year-old with modern technology and everything, that 3-year-old, God willing, will probably live well into their hundreds. That is a ton of time for money to grow. So start that policy immediately, because by the time they're even like 18, ton of money in there. And that way you don't have to go get college loans, which are the worst debt ever because they are unforgivable. Like you literally cannot even put those into a bankruptcy. Horrible. And then you pay a ton of interest to a third party, borrow from your policy, and pay yourself back what you would have paid on college loans. Now that cash value builds back up for your child. And then if they want to buy a car, borrow from the policy, pay yourself back what you would have paid a lender. So 100% get that policy ASAP. As far as premiums that are appropriate, that's really up to you, what you think you could do. What we do, guys, is we lower the death benefit to as low as possible and then have you overfund it. So let's say on that policy, you're putting in easy math, let's say $1,000 a month. You'd only have like the death benefit portion about $300 a month. So you'd overfund it by $700 a month. That's an option. You don't have to do that. You could put in $300 a month, but then you just have a regular death benefit or a regular whole life. So overfund it as often as you can, build that cash value up. But again, you don't have to. So if things get tight, you can put in less and catch up later. As far as the medical exam, there's not one required on minors. So generally what they'll do is they'll look up like past medical records. If there's a bunch of red flags, they might have an exam done. I've never had that happen with a minor. So they're usually pretty quick to get approved. Love that question though. Start that policy tomorrow.
Freddie asked in the chat too, is can we get a policy before he was born? And so you have a new baby on the way, so you can probably also answer that question.
Oh, I'm so excited for my daughter's new policy. Ugh.
But you can't, can you get one? Or you can't get one before they're born, right? Like it has to be.
No, you can't.
Day one.
Yeah, they have to have a social security number, and they don't have a social security number until they're born. Something in my head is sticking out that it's 2 weeks. They can't have a policy until they're 2 weeks old. I've got her policy up. So this is for baby Burr. Her name is Brooklyn. She is due in 12 days, which is insane. I'm going to have 2 daughters almost exactly 16 years apart. My daughter Haley, her birthday is November 29th, and Brooklyn's her due date is the 27th. Just crazy. So let's see if we go down to the illustration. Here we go. So I'm going to start this policy for $5,000 a year. I can put that amount in for the first 20 years of her life. This policy, I had it built to where it's not that liquid up front. As you guys can see, if I put in 5,000, I've got access to a little less than half the first year. That was on purpose, because if I made it super, super liquid, I would give up the growth later on in her life. Look, at even by the time she's 25, she still has so much more time to live. So I want to be able to have the growth really take off later in her life when she can really be using the policy. What I did is I structured the policy this way, put in 5,000 for 20 years. And then after that, I can only put in 2,600. So if we look at it, first year, I've got 2,400 available. Next year, about 5,000. And let's see when the break even point on this one is. Looks like it's right here. So cash value goes from 13.6 to 18.8. So it grows by about $5,200 for putting in 5,000. And she's only 6 years old at that point. The policy is now efficient, meaning every single year, the difference between the growth is higher and higher. So let's take a look at like when she's 20 years old. Cash value grows from 120 to 130. So I put in $5,000, it goes up by 10. Crazy. Let's say when she's my age. So I'm 38. I can put in $2,600. Cash value goes up by, let's see if my math's any good. What's that? 17,000, give or take. Crazy. Like, I wish my parents would have done this for me. She'll never have to borrow a penny from an outside institution. And this is just one policy. I plan on getting more on her because I have 3 on Haley. So I'm going to have more on Brooklyn as well. But if I started this policy when she was 10, let's say, it would be nowhere near as good because that would be 10 less years of compounding, $5,000 a year. So the whole point is start policies as early in your life as possible and get as much money in those policies as early as possible. So you give the money as long as possible to grow. Longer you give it to grow, bigger it gets, the more you can use. Any questions with this after you guys are actually seeing the policy?
This is incredible. This is an incredible policy. It's insane.
I can't wait. She's gonna be balling by the time she's like 21.
Any questions about this policy specifically? I think we have a couple questions in the Q&A that might be a little bit different. So
yeah, I think Phillips is
yeah.
interesting. Yeah, he's asking if this would be useful for chefs to know and utilize. And, I think that, we could look at how does a chef get to work? Does a chef drive a car? So a chef would need a car. This would be perfect for a chef. I mean, anything that you need to finance, can be done through this process, right? So.
Yeah, I mean, even if he wanted to open up his own restaurant, you know what I mean? Like financing the equipment, the startup, probably even in that case, even if you were a restaurant owner, I don't know. I'm just thinking out loud, but I mean, potentially even paying for the stock and the stuff that you bring into the restaurant that is also going to make you money. Like it's just same as like a real estate investor buying things for their property.
I'm a firm believer, guys, that anybody should use this. Anybody and everybody, because everyone has money flowing somewhere. The dollar amount is that's arbitrary. Everyone has some sort of money flowing somewhere. And most people have it flowing to the wrong place. They have it flowing to a bank. A bank then takes that and lends it out to other people to make a spread on the money. That's all infinite banking is. So instead of it flowing to a bank, have it flow to a policy. Now you can take it and make a spread on money. Here's a great way for anyone to do it. How many of you guys out there have one of these things? Or maybe several of them, right?
Yeah.
So what do you use these things for? Why do you use this instead of cash or instead of a debit card? Well, this one is Delta Sky Miles. I use this because it gives me Sky Miles. I've got some that give me cash back. I've got some that, you know what I mean? Just different things. So I use all my credit cards I've got one that gives really good cash back for gas. That's my gas card. I've got one that gives really good cash back for eating at restaurants. When we go out to restaurants, that's the card I use. So I use all my cards throughout the month to get all that cash back, all those rewards. Instead of paying the credit card companies 20, 30%, whatever it is, I just take a policy loan, pay the cards off at the end of the month. That way, no interest is due. I'm actually getting paid to use the cards because of the different benefits. And then I just pay my policy back as if I was the credit card company. Pay myself back $1,000 a month, $1,500, $2,000, whatever it might be. Anybody could do that. And that's just using it for your daily expenses. Clothes, gas, food, any bills that you can pay with your credit card. So that's one easy way to use a policy. Anybody and everybody could do that.
I agree. I do that as well. We did get one question about your daughter's policy. So new baby births is what determined that annual premium deposit? Like what made you pick 5,000?
I sent it to Sandra and I was like, hey, I want to get a policy for Brooklyn. And maybe that's all that they would approve at the time. I don't know. I'm going to push back on that. Who asked that question? Now I want to ask Sandra. I can put in more than $5,000. So if I can put in more, I want to do more.
May asked that. And then I think so did somebody else in the chat. We had a couple of people just ask kind of, where we come up with these numbers. Most of them are a comfort level as well, something you can comfortably pay.
Yep. Well, guys, I appreciate you guys saying something, and little Brooklyn appreciates it too, because she's going to have a lot more money in her policy if I can actually get more in there. For some reason, I think Sandra said that was the most we could do, but that doesn't really make sense, because guys, the way it works is kids can get approved for generally 50% of the death benefit that the parents have. And I think just on me, not including her mom, I think just on me, it's like close to 30 million. So that means that Brooklyn could get approved for $15 million in death benefit. I think that policy was only like 600 grand. So yeah, I'm going to push back. So thanks, whoever asked that. I appreciate you. Brookie appreciates you too.
Felix brought up a good point. Vivi's policy that Chris always shares is about a $5,000 annual premium too. So there might be some funny reason. Maybe you'll get more later on.
Because they're so young, possibly.
Maybe it's moral. You know what I mean? Like, I don't know, like, so people don't do anything weird with life insurance scams.
Well, there typically are some maximums that, even though Devin, you've got a high death benefit, sometimes they clip them off at kids' policies at 500,000 or a million, and then you have to put a business case together to go higher. But so maybe some of that played into it.
Yeah, I'm trying to see if Sandra said in the email why.
And then Jay has another question about his 18-month grandson. If I start a policy on my 18-month-old grandson and something happens to me, so his grandpa, is the premium able to be paid or taken over by someone else, such as his mother? So that is interesting, because there's the insured and then
ownership
the
can change.
Okay, ownership can change, Jay. So yes, you can change the ownership over to his mother.
Yeah, so there's three main players in the policies. There's the owner, the insured, and the beneficiary. The only thing that can't change is the insured, but the owner can change and the beneficiary can change. So at that point, you would just say, since I'm the owner of this policy, it would then be transferred over to whomever you list. It can't be a minor, though. You can't have ownership. A minor cannot have the ownership. So other than that, you're good to go.
Jimmy Davidson asked a really interesting question. So you know how there's another thing too, is like you can't necessarily just get you can't get a policy on just one of your children, correct? Like if you've got 4 kids, and then like you can't just pick your favorite and then not that you would, but like, and get a policy on them. But so Jimmy's also asking, like, did you have to get a policy on Brooklyn because you have one on Haley?
No.
No.
Because I got policies on Haley before Brooklyn was born, obviously, or even thought of. If Brooklyn comes around and I'm not in a position to put a policy on her, I don't have to. It's when the kids are alive at the same time. So let's say Brooklyn's born and Haley's around. I can't get like 2 policies on Brooklyn and have 1 on Haley, or 0 on Haley and 2 or 3 on Brooklyn. It just can't happen. They want to make sure you insure. I think it's generally they got to be assured for around the same amount on the death benefit. I could be wrong on that, but I believe that is true.
So Devin, any extra money we have should go back into the policy to pay down the loans. I have 3 private loans out earning interest right now.
Yes and no. It depends on if you've got a better use for the money. Remember what I said at the beginning. Infinite banking is just all about making a spread on money. So if you have loans out and you're paying 5% interest and money comes back in that you can pay those loans down on, that means you can reduce the amount of interest you're paying. But if you can take that same money, instead of paying these down, and deploy the money to make more than 5% interest, just do that. So it's all about keeping that spread. So if you have no place for the money to go, no opportunity for it to grow, absolutely pay the loan balance down as quickly as you can, because then you're just storing money in the policy. If you pay a policy loan down $50,000, you got $50,000 sitting in that policy that you could deploy as soon as an opportunity comes.
Jimmy also asked a really good question too, is with all the policies now in place and their associated premiums, do you ever find yourself short when premium deposit time rolls around? Guess I'm asking if you're always sleeping like a baby or if you're overextended at times.
I sleep like an absolute baby for now, because there's a new one coming. So I'm going to be a little sleep deprived soon. But I don't overextend because I always know I'm at the point with some of my policies where I put $1 in, I get more than $1 out. So I can easily take like my equity line on my house. I did this for a policy that just came due recently. It was $50,000, and I just didn't have 50 grand just sitting in one bank account. So I just wrote a check from my HELOC, paid the 50, but the policy grew by like 56. So I just took a policy loan for 50, paid off the equity line. Now I've got that extra 50,000, which is the bank's money, not mine, compounding for me for the rest of my life. I've had times where like I've had to change the premium mode. So I try to do all my policies annually. Reason for that is because if you get all the money in there from day one, it just has longer to grow. So it becomes a bigger number. However, if I just don't have the funds, I'll change it to like monthly or quarterly or semi-annual, put what I can in there, and then switch it back to annual later on. So there's always options.
Amazing.
I think that hits a question that Jalen asked about how would you use a HELOC for a policy? Well, that's a great way. I mean, the HELOC can pay the premiums. You know, if you're running everything through the HELOC, it can just pay the premiums. Money comes back into the HELOC. So that's one way to use a HELOC to pay for a policy. You could also deploy some of that money from the HELOC into, say, private lending and have it create cash flow, and that cash flow comes back into your system. So it's all about taking that lazy cash, as we call it, and putting it to work.
Absolutely. Ricardo has a good question too, that like a lot of people might actually be in this situation. He said, so I guess I'm doing it wrong. I have a policy now with about 50,000 just sitting in it. I wanted to hit 100,000 so I can loan to PMC. Should I start now? And that's a good question, Ricardo, because a lot of people probably do the same thing.
Yeah. I mean, there are opportunities in Private Money Club that you don't need 100,000 for. So you could certainly put that money to work sooner than later. And that's just going to accelerate you getting closer to the 100 faster. So
true.
Lois is asking what a HELOC is.
Home equity line of credit.
And then Lynette is asking, I had the same question this morning. I have a HELOC, but how do I pay the payments on that if I put it in my policy?
How do you pay the payments on the HELOC?
Yeah, maybe if she takes all the money and puts it into the policy, then maybe she's worrying about the actual HELOC payment, like at the next month or something.
Yeah. So there's so many ways to use a HELOC. You guys want to think about it as using a HELOC early on with a policy is good. Using it later on when your policy is efficient, like I said, mine is. I put in 50 and it grew by 56. Then it's just great, because then you're just using the bank's money to compound for you and there's no risk. You can just take the cash value, pay off the equity line. Early in a policy, you don't have full liquidity. So let's say you put in, easy math, $100,000, and let's say you've got 90,000 available in cash value. So 100 grand goes from your equity line to your policy. Now you owe 100 grand on your equity line. You borrow against your policy 90 grand, pay down the equity line. Now you only owe $10,000. And equity lines are usually amortized over 20 or 30 years. So if it's, let's just say a 20, worst case scenario, 20-year term on $10,000, rates are like 8% right now. That's only an $83 payment on the equity line. What I would do, you've now got 90,000 available on the equity line. Take it, lend it on a private money deal. Let's say 90 grand at 12%. That is $900 a month. So that's paying your equity line, that that payment of, what was it, $83 and some. So you're actually getting cash flow using your equity line. And you've got $100,000 compounding in your policy at the same time. Hopefully that makes sense. If I could draw it on a whiteboard, it'd probably make more sense because you'd be able to visually see it. But
there's so many questions and they range all over. So I'm trying to like pick ones that we're sort of already talking about versus just so sporadic. But you mentioned you pay back with business account. Can you take business income and use that in your policy?
yeah, you can fund a policy. If that's what they're asking, you can fund a policy from anywhere. It doesn't matter where the money's coming from. So if you have money coming into your business and you got a policy due for premiums, you can pay those premiums from your business account. You just can't have policy loans go from your policy to the business account. They have to go from your policy to your account because the policy's in your name. That's actually a benefit too, because then if the money's in your name from the policy, you can lend it to the business. So you can create a note between yourself and the business. If you're just lending straight to the business, you can't create that note. So you can't create like an extra tax write-off and stuff like that.
Nicholas is saying, I assume you could be the owner of their policy, so I'm assuming your daughter, until they're older, and use that policy to make investments and then have a plan to have the loans paid back by the time they would start to use it. And I would say, yeah, that's pretty much usually the plan.
Yep.
Yeah, there's another strategy, more of a legacy play on that too. So if you're the owner of your kids' policies and you use all the cash value and don't necessarily replace it, guess what? When you pass away, or as we call it, graduate, now those kids have your death benefit that they can backfill their policy with. You don't always have to have that kid's policy filled back up, but if you do want to hand that off to them at some point, then you might want to. But there's so many cool strategies to building that legacy out.
Yeah, what I do, guys, is I actually have to use one of my policies soon for my daughter because she's going to be 16 in 14 days, exactly 2 weeks. So I'm surprising her with a car. So I'm buying her a car from a policy, and she does not get the car until she gets a job. So she gets the car on her birthday, but I'm using it as like a carrot. I'm dangling the carrot in front of her. She's going to want to drive that car. But sorry, baby, you can't drive the car until you get a job and can pay payments on the car. I'm basically structuring the loan to where she'll be able to afford it, but she'll make payments back to her policy. And I'm going to have a contract in place. So if she breaks that contract, if she does not make a payment, she doesn't get the car. Same thing as if she was to borrow the money from a bank. Here's the thing. My daughter already understands this stuff because she hears me talk about it all the time. Why would she not pay a payment? Because it's going back into a place that she can use again and again and again. Basically, what I'm going to do with her is I'm going to own the policies for as long as possible until I know without a doubt she can run it on her own. And the way I'll know that is I'll just, whenever she wants something, I'll use her policy, have her pay it back with interest. As long as she keeps doing that and she doesn't steal from her bank, eventually 18 or over, I can assign it to her. Now it's her policy. She has full control over it.
That's amazing. A lot of people are asking what kind of car. Everybody's really curious.
Oh, it's the car she wants. It's a graphite. That was very specific. She wanted a graphite color. And it's a Hyundai Elantra. The new body styles are pretty sleek looking. I actually like the car. I think it's cute.
That's awesome.
I wanted her to have a 2-door though, so she can like pile friends in the back and be distracted. But because I remember me when I was a kid, I got the 4-door, so all my friends would pile in the back. That was before smartphones. So I don't know. I'm scared to have my daughter just drive on her own.
Crazy. I remember me and my friends, we got 6 people in an Audi TT once.
Of course you did. So dangerous.
I personally have to run. I have to go pick up my daughter, but there's a few more questions. I'm going to let Craig kind of help you guys close out, but thank you guys. This was awesome.
Appreciate you, Shauna.
Thanks, Shauna. interesting question from Anna is asking about what if a person's living paycheck to paycheck? How can we use infinite banking? And I think the short answer is this does require you being able to put savings into the plan, paying yourself first. But
so what I would do is I would take a really deep dive into your finances. There's probably things you can cut out. If you're getting Starbucks every day, not saying you are, but if that's an example, Starbucks is probably $5 a coffee. If you're getting that 5 days a week, let's say every day you're working, that is $100 a month right there. So that could go into a policy. Instead of getting Starbucks, get a Keurig, right? So there's different things you can do to really just scale back what you're spending. Because the second you spend any money, it's gone forever. You'll never get that money back. If you can simply just lower the amount you're spending, and then that money you're saving now from a gym membership that you haven't gone to the gym for years, and it's coming out automatically, $10 a month, $15 a month. There's actually an app, I think it's Rocket Money, where you can, it actually notifies you of all these little charges you have coming out all the time. And you can say, like, why am I paying for that? Why am I subscribed to that? You'd be surprised how much money you could save right there. So first thing is scale back what you're spending, then put that money into a policy. As it builds up, then you can start taking it and knocking debts out and recapturing the money you're paying on those debts. And it just has a snowball effect where you can become wealthy over time using your own debts and expenses. Hopefully that answers that.
That's awesome stuff. The other thing I would say, you could just take a look at your own personal economy. And when I created my first policy 15 years ago, what I did is I quit funding my 401k. And instead of funding a 401k, I took all that money and I put it into a policy. So you may be living paycheck to paycheck, but what are some other things that you might be putting your money into that perhaps could be redirected into a policy? So some of that just kind of comes down to looking at your entire personal economy and where money's flowing. And that may be something to consider. Would it be beneficial to have the owner of the policy for children be a trust? I mean, there's a lot of different trusts out there. So, sometimes it makes sense, sometimes it doesn't. But yeah, I think that could make sense. So I don't know if there's any specific questions you had on that, May. But anyway, that is certainly possible. You can have a trust be the owner. The trust could be the beneficiary. So those are all possible. And along that same trust, Katie's asking, can I lend through my trust? Now, if you're asking about, can you do private lending through a trust? Again, depending on the types of trust structures, then that is possible. Really, what we're doing is think of it this way. There's money leaving an entity. If that trust is the entity and it has the money, then you create the promissory note with that particular borrower. So the trust could be the one to do that.
Ooh, Jimmy just made such a solid point. When the trust is the owner of the policy, the premium deposits become tax deductible. Such a huge benefit, guys. I have all but one of my policies owned by my trusts. So all the premiums I put in are a tax deduction, dollar for dollar, I believe. Correct me if I'm wrong, Jimmy. Dollar for dollar deduction off of my taxable income. That's just mind blowing when you think about it, because you're getting money in that's tax free, and then it grows tax free, and then you can use it tax free. And then when you pass away, it's paid out to your family income tax free. And if you have the trust set up, it's also estate tax free. So just ridiculous. Such a good point, Jimmy. I totally forgot about that. Dollar for dollar, he said. Love it.
Let's see. So Jasper's got an interesting question asking about what are the issues in handing over a high value, imagine the high value cash value to your children via ownership change. So I think there's a couple different pieces I would look at. One is, are there any sort of tax consequences? And maybe James, you want to comment on this? I know we've had this conversation come up and ask me anything in other types of forums, but when there's a change of ownership, is that considered gift tax? Is that considered something that's taxable in that exchange from ownership? So Devin, if you're going to exchange ownership or change ownership of your policy to your daughter, what are the tax consequences of doing something like that? I've heard a number of different things. So Jimmy's saying ownership change triggers tax consequences. It can be offset by your gift tax exemption. So, there's that taxable piece that needs to be ironed out. And I'd say talk with your CPA about that, because Devin and I are not CPAs.
This is true. We are not CPAs. I just thought about this though. Actually, I wouldn't have that problem because my policies are owned by my trust. It's an irrevocable trust. That means whatever goes in it, it can't come out. So once I put the owner of the policy as the trust, it can't be changed. So my daughter's policies are in the D. Burr family trust. So she will have access to those policies, but she's not the owner. The trust is. And that means I'm not the owner. That's good. I don't want to own anything. I want to control everything. If I own things, people can take them from me. They can do judgments. They can do lawsuits. They can sue me. If it's owned by a trust, especially the kind of trust I have, it's a complex trust. There's so many levels of protection in that thing. So yeah, I just thought about that. I won't have to worry about any kind of taxation because I won't be having an ownership change, which is nice.
Well, your ownership change goes into the trust, but that gets handled differently. But for somebody that doesn't have that structure, just be aware, as Jimmy mentioned, there could be some tax consequences. So that just needs to be ironed out with your CPA.
What does Jimmy know? He's just a CPA.
Yeah, Jimmy, come on, Jimmy. And then Kat asked a question in the chat: can you transfer ownership to a trust? Yes, you can. And I've done that on a couple of my own policies into my own trust. And like Devin's talking about, it's something where I no longer own it, but I control it. And so that can be done. Let me go back into the Q&A here. So, the other piece of that, Jasper, I think there's the monetary piece of it, of the tax consequences, but are there other issues with handing over a high cash value policy to your children? And I think Devin hit it right on the head, is when you feel that they're responsible enough and that they will take care of this asset, then it would make sense. But I would not hand over this type of an asset to a child that had no idea how to use it and how it works. So I would say that's the other aspect I would consider.
Yeah, you want them to prove that they can use it. So lend to them, have them pay you back with interest, have contracts in place. If they miss payments, they don't get the asset. But if they continually show that they're a good banker, they're an honest banker, then think about assigning it to them. Policy loan payments are not tax deductible. So we're talking about in a trust. Looks like Robert asked this. In a trust, the premium deposits, those are tax deductible if the trust is the owner of the policy. So there's loan repayments and then there's premium deposits, two separate things. The loan repayments are not tax deductible.
So Lynette's asking if to put it into your trust, you have to have a business. And no, not necessarily. So you can have a business trust and you can have a family trust, and those policies could be in either one of those. Jasper is also asking if children are over 21, could I pick and choose who I want to insure? So once you no longer have minors, yes, you can pick and choose. So they're adults at that point, right?
It'll be a little harder, guys, to get those ones approved because the insurance company will push back and say, well, why isn't they're an adult? Why aren't they the owner of the policy? So easy way around that is have them be the owner of the policy and then just assign it to you once it's funded.
And you can also list yourself as the payer. They could be the owner and you could be the payer. So that could be done as well.
Yep.
So Danny's asking if he could get a policy on a 15-year-old autistic child. And I've had some cases go through and they will approve that based on underwriting. So it's just a matter of, depending on the situation, we may be able to get that through. So that'd have to be dealt with on a case-by-case basis. And George is asking if there's any way to work with Devin for policy advising.
Shoot me a message on Instagram. That's the easiest way to get a hold of me. Mr._Burr, B with 4 R's.
And then David is asking if you can share your CPA with us.
It's this crazy fool in the chat, Jimmy Davidson.
There you go. Jimmy's in the house, so just reach out to Jimmy.
No, but Jimmy is actually not my CPA. Great CPA. I don't have a CPA. I have a tax attorney. So I do everything through the tax attorney, and then his office has like a CPA that does everything there as well. I don't really know how all that works, like who the CPA is, what the tax, like I just know the structure that they set up for me and they take care of everything. So, but Jimmy Davidson, great guy. Reach out to him. Ricardo asked how to get a trust. I'm going to put in the chat here, guys, a link where you could schedule a free consultation to get estate planning done. So this company that I work with, they'll do estate planning. They'll do, I don't know if you guys see it, they're prime partners. So they'll do estate planning. They'll do entity creation. So if you want to get an LLC set up, an S corp, they'll do tax planning, tax strategy. They'll help with acquiring business credit. So if you click on that link and just schedule a call, free consultation to see how they can help you with those things.
Okay, so we're getting down to just a couple left here on the Q&A. So Ricardo's asking if he opens 2 policies for his kids, dump in $5,000 each per child and $1K a year. Got a letter from the insurance saying it would be a good idea to put more than $1K. I'm not sure what's going on there. So Ricardo, if you have 2 policies already and they've already been set up to hold a certain amount of premium deposits, that's kind of how you'll fund them. But it sounds like there may be some more room in the policy. If that's what you're asking about, then, absolutely. If you've got the money, put it in.
Yeah, it sounds like what it is, Ricardo, is they set your policy up with probably a PUA rider. That's paid up additions. That's overfunding a policy. That's what gets cash value. And the $1,000 a year that you're putting in, probably most of that is base premium, which does not create cash value early. That's how I'm reading that. So if they're saying you can put in more, they're saying you can put in paid up additions. So I would call the company and just ask them, what's the most amount of money I can put in the policy this year in paid up additions without it becoming a MEC, MEC. And they'll tell you down to the dollar amount. So if you're able to put in $4,000, that's money that's going to compound and grow tax-free, be protected in the contract, and you have access to it because it's paid up additions. You have access to like 96% of your paid up additions that you put in right away.
So we have one more question in the Q&A, and I think this is more of an estate planning topic here. So Maya is asking, do you specify, so when you pass away and you want your children to create a policy, how could that be handled? And I think that would really just be done in your last will and testament. I mean, again, it's probably estate planning, how that could be handled. But your trust could set up the policy. I mean, you would structure it so that when you pass away, your trust could create the policy. But as far as all the mechanisms of how that work, I would talk to estate planning about that.
Awesome.
All right. Did we miss anything? If we missed anything in the chat, so the chat gets pretty busy. So if you do have any specific questions, and I see George has got his hand raised. George, if you want to put your question in the Q&A, we can get to it. So we've got about 10 minutes left. And what else is going on today? So at 4:30 Eastern, ask me anything. If you're on Chris's YouTube channel, you can catch it up from the YouTube. There's on Facebook. But who here on the call today is going to be on Ask Me Anything later on? Just go ahead and put an I in there. I'm just kind of curious if anyone's planning to join. Brian, Anna, awesome. Rick, Lynn, Freddie. Perfect. All right. Well, we've got a lot of people that are going to be coming on to the Ask Me Anything. So Lois is asking, how do I join? Angela's asking, how do I join the Ask Me Anything? Yep. So everybody that wants to participate in the Ask Me Anything show, that's where, and Devin, I'm not sure if you're going to make it today, but we typically have most of our team on, and similar to what we did here, we just kind of answer questions. So if you can join that, that would be awesome to see you out there. Let's see, who will be on the panel for Ask Me Anything today? I think Chris and Steven are traveling, so it's probably going to be Joe, myself, Gabby's usually there, Shauna is often there.
I won't be able to be on, unfortunately.
So what time is Ask Me Anything? 4:30 Eastern. And then the last question, then we'll go ahead and wrap it up. But Brian is asking, so he's got 3 adult children. He wants to open a policy per child for 3 years in a row. Or do I need to split my premium money into 3 separate policies each year? So Brian, this is kind of what Devin was talking about earlier. Because they are adults, we can submit one by themselves, but a lot of times it makes more sense just to insure them all at the same time, kind of split that premium up across the 3. So either way is an option, but you might have an easier time getting through underwriting if you just create 3 policies, split their premiums, across the 3. All right, Devin, you want to wrap us up? Give a few words of wisdom.
Anna said, one of these days I'll understand all that you guys are talking about. I can't wait. So that's so good. What I would say is just Anna and everyone else that this stuff seems kind of foreign, just get around it as often as you can, because if you do something, doesn't matter what it is, if you do something enough, you're going to become an expert at it. When I say enough, I mean just a few hours a week consistently for a year, 2 years. You're going to be an expert at that thing, because most people don't do that. They start something and then they stop. Start something and they stop. So keep reading books about the concept. Keep getting on these kind of webinars. Keep doing your research. Just keep learning about different ways to use the concept, and you'll inevitably get better at it. You'll understand it more. And then what I would urge you guys to do is, when you start understanding it, teach it to other people. That's what really set me on another level, is when I was doing the policies and I was using them. I had 4 in the first 6 months, actually. I had 4 policies. I'm using them like crazy. I'm understanding them. I'm seeing how they work. Once I started teaching other people how they worked, my mom, my dad, my brothers and sisters, friends and family, got on social media, started teaching it. It all just started making so much more sense, because not only am I using it in my own life, I'm teaching other people. So I'm reinforcing it all the time. So I would urge you guys, the more you start understanding, just start telling other people, start teaching other people. And then when they want to do it, because they're going to want to do it if you explain it correctly, you know where to send them. We'll take great care of them.
Awesome, Devin. Thank you so much. And Ken, just to let you know, I put in the chat the link to the wealth webinar replay. So you're asking about how to watch this again. Every wealth webinar that's been taking place on every Wednesday, that's recorded, sent the link to you, so you can go back and watch those. And really what Devin's talking about is being around the campfire and continue your learning. Join the wealth webinars. You don't pay for this. We just show up every week and do it. The Ask Me Anything, whole team shows up to do it. So we're here making ourselves available to help you and educate you as much as we can. So get around the campfire. All right. With that, we're going to go ahead and wrap it up. So I'm going to go ahead and stop the recording. Appreciate everyone joining today. We'll see you on Ask Me Anything, 4:30 Eastern.
Thank you guys. Appreciate you.
All right. So